Good afternoon, friends. So we are executing a covered call strategy on Nestle India. So basically, we are slightly bullish on it. So 19,838 is the price at which we are going long, and 19,800 is the call that we are selling. So basically, we will be getting couple of margin benefit. The total margin required is around 1,06,000. Let's try executing that. Let me just cross check the price once again. Uh, yeah, futures is trading at 405 and sorry, call is trading at 405 and futures is trading at 825. uh, so usually I use trade genie. They provide a platform called cube, which is more user friendly. So let's execute. So I think the order has gone through. Let me just cross check that. Let's go to the orders. Yeah, so we have bought it at 19,838 long position, and we are selling a call here at 408. Now let's see how much margin is left out. Yeah, 16,000. I'll add another couple of 20, 30,000 to be on a safer side, because in case of the high volatility, if the margin increases, remember margin is calculated based on war margin. So in case if the margin increases, then I will have to add additional things. So I usually keep some excess cash there, and it's pretty good. Now let's come back to the chart. As you all know, I use Ichimoku extensively for trading. So I'll tell you a couple of things about Nestle India. The best part about this stock. Uh, so usually, like I go with a 1 hour chart. Okay, and we have customized couple of indicators. So let's just keep it simple and straight. Uh, so here you can see this particular stock, like it's been inside the cloud for a pretty long time. Okay, so it just broke out around the 19,537. So in one of the WhatsApp group, we had given a buy call at that point of time. Now see, if the things go worst, let's say, okay, because typically what happens, the market exactly does opposite majority of the time what is seen in the chart. Like now to shake us out, what it may do, the market may actually come down to 19,300. And then it may go up further back to 19,900. Or in the worst case, what it can do, it can come down to somewhere around 18,500. That is where basically the weekly support would come. Like if you go for a weekly chart, you find it there. So like how I would trade is basically, let's say if it comes to somewhere around 18,300 level, I'll be adding one more future slot there. Now to add that one more future slot at that level, basically I'll release the margin from the call option. Remember this call option which we have looked in there, this particular position which we have taken in the call option. Now this will become zero value in case if it comes below 19,200 level. So that margin I will use it to buy an additional position at that level. Okay, but looking at the chart currently based on the Ichimoku chart, Nestle India should have a strong support somewhere here around 19,200. That's all the game there. Looking at 19,200 as a support level, I'm taking a long position there. Yeah, but like but told you earlier, you need to keep sufficient money in your account, because in case if it from 19,800 it comes to 19,200, you will have to pay around 600 rupees per share there, and into 25 that will come somewhere around 15,000 rupees. So you need better to keep around 20, 25,000 as a mark to market losses, 25 to 30,000 as a mark to market losses, and then you can basically take a position there. So let's see how the trade goes through. So the main idea is, in case if it comes to 19,200, I'll be exiting this call option. I will be exiting this call option, which will give me around a 400 rupees again, and I will stick on to this futures position. In case if both of them go through it, then on the expiry day, the exchange would do the netting. Like you can read about how the netting would happen here. I'm actually going by the Zerodha's what do you call explanation on how the netting happens. So here you can see there is a long futures position that will be offset against a short in the money call position. So it will not get converted into a physical delivery. That's what Zerodha and exchange circular says. So let's take a call somewhere on, I think 22nd January, when the expiry is due. I think 28th I think 27th is the expiry for this particular trade. So around 21st, we will be looking into the position and we will be doing the adjustment. Thank you all. Thanks a lot.